What I have for you today is a follow-up from last week. Last week, we looked at Pillar 1 and we used Facebook, the 2020 numbers, as an example of trying to roughly estimate what the consequences of Pillar 1 would be for Facebook. Just a quick recapture. We looked at Article 6, the allocation of profit, the relevant profit for the adjusted, the relevant portion of the adjusted profit before tax, taxable in Denmark, is equal to the amount of profit allocated under the formula set out in paragraph 2, and that would be this formula that we have here. And then this is our calculation, and then it must be reduced by the adjustment set out in paragraph 3, and that's what we'll calculate today. So for our allocation to Denmark, we said that the financial accounting profit of Facebook was 29 billion. There was tax expectance added of 4 billion and disallowed expenses, fines for selling personal data of 5 billion, and they came to an adjusted profit before tax of 38 billion. And then you took we also looked at the Danish revenue, which was 936 million kroners, which we translated to $132 million. And then we said if we apply this formula here to that, then we get to a final profit allocation to Denmark of 11,406,501 kroner. So it's quite a significant increase from the original Danish taxable income, because the original Danish taxable income, as you can see here, was 22,900,000 kroners, which translates to $3.3 million. Now, if we look at the increase in tax, if we divide 11.4 by 3.3, that's a 344% increase. And I don't think it's surprising, because if we try to calculate the original cost plus on Facebook's numbers, and here I work with their gross sales and then the payments that they made to presumably third parties, but probably also to the Facebook group in order to make these sales. Then you get to their gross sales were 919, and then they paid 936 million to generate these sales. That also includes other costs of sales, which they show in their P&L. And you come to cost plus 2 on a T&M basis, which is maybe a little bit on the low side. And if you could apply the classic resale price method, you again get the same 936. You take only their COGS, which comes to 867, and you divide that by 936, and then you come to a COGS on gross profit of 7%, which for most businesses would be way too little to pay all their personnel and their office rent and computers and stuff like that, everything that normally would go under OPEX. So it is not quite a surprise that there is an increase in the income allocable to Denmark under Pillar 1. So let's see what we do now. From here, just to recapture again, we said that what we want to do is we want to calculate the tax due in Denmark. We've now looked at the global marketing profit for Facebook. We've looked at the profit allocable to Denmark, and this is both for Facebook Denmark, where we assume that all the turnover that was generated by Facebook Denmark is indeed also the income that would be allocated to Denmark under I believe it is Article 4 of Pillar 1, which deals with how you determine the source of income, right? That's a dangerous assumption, but we've made it in any case. And now we've got this residual amount that we still need to deal with. And what we need to do is we assume there's no funny business. I mean, Facebook is not involved in banking, mergers, splits, or acquisitions, or the extraction industry. And so now we're going to determine the tax due on income allocable to Denmark after we've deducted any active income deductions that are provided for, which is what we'll look at next. And then finally, we will calculate any double tax relief. I must say that what's coming up is, again, complicated. I am quite sure that I have misread some of the text and that my calculations are not correct. But feel free to adjust me where you think I've gone wrong, because I've done my best to do them as accurately as I understand the text. So let's go further. Article 6, as we said, the relevant portion of adjusted profit before tax, the taxable in Denmark, is equal to the amount of profit allocated on the formula set on paragraph 2. We've already done that, reduced by the adjustment set on paragraph 3. And then the adjustment at paragraph 3 is the marketing and distribution profit safe harbor adjustment. So this is a deduction for the active income, and to make sure that you only really hit as we will see in the final text, the residual profit, or the marketing part, I assume, of the residual profit, right? So let us see. We're going to use, just to understand the text a little bit better, because the actual text of the legislation is quite complicated. We're going to look at the progress report on amount A, because there's some frequently asked questions which are responded to, and they explain things in a little bit simpler language. They say the marketing and distribution safe harbor, MDSH, is primarily designed to address issues related to double counting, so you don't add things twice, right? For example, this may occur if a market country has the ability to tax the residual profits of an M&E in two ways: once through profit allocation rules, typically transfer pricing, and again through amount A. And in case of Facebook in Denmark, this is possible because there is already a taxable entity in Denmark, right? To prevent this in circumstances where a market country already has taxing rights over M&E's residual profit, an additional step is included in the calculation of the amount A to reduce the profit reallocated to that country by the amount of the residual profit already taxed there. Yeah? This includes a formula to determine the precise amount of reduction for each market country where applicable, and the quantitative criteria to identify the residual profits already taxed in that marketing country, right? And then important several aspects are still under development, and I think that's maybe why the formula is so unreadable. But if we apply logic to what's going on here, then I would simply use what we've used for the Facebook group already, right? I would say for Denmark, you take the adjusted profit, which is the profit which is reported, and you add back the tax and penalties and all that kind of stuff, and you deduct from that 10% of this 900 million, which is revenue, and that should be your adjusted profit. Now for Facebook, that would come down to 22 million minus 93 million, which is 0. So there is no residual profit to be deducted in Denmark. And considering the fact that we've just looked at the Facebook numbers and concluded that they actually reported, in spite of the way they make the P&L look in summarized form, a cost plus 2 on a T&M basis, or a resale price of 7% on a gross profit basis, it's not a surprise that there shouldn't be any residual profit. But if we follow the OECD Pillar 1 text, we actually come to quite a significant residual. So let's see what it is that they do. They say, paragraph 3, we've just looked, the marketing and distribution safe harbor adjustment shall apply to reduce the amount of profit allocated to Denmark. But we first need to see where a covered group meets the conditions set out in paragraph 4. Paragraph 4, we're just putting in the profit already allocated to Denmark is 11 million. And then they say paragraph 3 only applies when the elimination profit of a covered group is equal to or greater than X million for the period, right? So we're not going to deal with small numbers. And 11 million is not a small number, so we'll assume that we will have to do the calculation for the marketing and distribution profit safe harbor. Now the calculation looks something like this. You take this is your deduction is M, and then you take the minimum of either Q, which we've just calculated, which is the 11 million, or it is your earnings, your elimination profit minus your portion of elimination profit, that is something multiplied by a percentage, right? So what this tells us is that E minus EP must be a whole number, and then you multiply that by a percentage, because multiplying a percentage by a percentage would make no sense whatsoever. So starting with the formula, let's see, we have a definition here. The EP is the elimination profit, right? And the definitions under Title 7 say elimination profit of a covered group for a period in Denmark means the sum of the elimination profit for each entity in that jurisdiction calculated under Schedule 1I. Now we have one entity. So let's see what Schedule I says. It says the elimination profit is the sum of the elimination profit under Section 2 subject to a reduction of available loss carry forwards under Section 7. And we'll assume again, also because Facebook was paying tax in Denmark, that there are no loss carry forwards. And then the adjustments, which are referred to in Section 2, is you take the entity financial accounting profit and you adjust that for, you add back the tax, so you deduct all the dividends and again gains on shares and stuff like that. This formula looks very familiar, right? It looks like what when we calculated the income for Facebook in general. And if we look at the text of Article 5 to compare to Section 2 of Schedule I, you can see with the first three numbers are exactly the same. And then we've got policy disallowed expenses, so fines need to be added back, and prior period errors and changes must be fixed in the period when you discover them, as we talked about in the previous video. And then you've got some accounting adjustments, as I said before, that you also need to deal with. And then there are a number of issues that are not dealt with, such as you include the revaluation method gains and losses. I'm not quite sure what that means. We'll have to wait and see what the guidance say. You also include gains or losses arising from assets and liabilities. Oh, sorry, these gains and losses arising from assets and liabilities excluded under Section 6 are excluded. And this basically means any assets and liabilities which have moved within the group, you take out. You'll see that in a minute. And then you accrue. You include, I believe, accrued pension expenses, and you also adjust for stock-based compensation. I guess if you issue stock to cover your share options and that hybrid, profits are excluded. Again, we'll have to wait for the commentaries to see what this means. The other sections that are covered in Schedule I are you need to deal with covered group allocation income or losses between a main entity and a taxable present. So you need to take out your PE income or losses, is how I understand that. You also need to deal with allocation in flow-through entities, and I think the general rule is you simply ignore the flow-through entities. Group entities joining and leaving the group, obviously the same income and same losses cannot be transferred and used twice, so that's how you split it between them. And then this transfer of assets and liabilities, you need to adjust for that because you need to take them out of the P&L, as we saw in Section 2. You need to eliminate losses, and then there is a whole number of definitions to deal with again. So if we take a bit of a simplistic view, this was Facebook Denmark's P&L for 2020. Then we will basically take the profit before tax and we'll translate that to US dollars, and we'll say that is $3,317,355. So this would be our elimination profit, which we can now fill in our schedule here, and then we can go and see what the rest of the formula is saying. It says we now need to calculate PEP. PEP is the portion, and this is an unreadable sentence, one of the most unreadable sentences I think of the rules. But let's see how far we get. PEP is the portion of elimination profit in Denmark, which would result in a return on depreciation and payroll of the covered group in Denmark equal to the elimination threshold on depreciation and payroll of the covered group, right? So we need to look at the elimination threshold on depreciation and payroll of Facebook, or 40%. So we need to take the higher of those two.